Hello, traders. Leah here from TMAT, Trading Mindset and Data. Today, I want to talk about falling knives and why you have to be careful buying those, and what's the difference between investing in this kind of beat up stocks and trying to trade them, and how you can avoid losing a lot of money while buying the dip that keeps dipping. Let's talk about UNH, for example. Market and also stock life has four stages: one, two, three, four. Stage first is accumulation. For example, after bear market, you see a huge time that's spent accumulating, and at some point, the stock and the moving averages will align horizontally, and when they align from the lowest to the longest, for the shortest to longest, 10, 20, 50, 100, and 200, and you have a breakout of this. If this kind of a range, that's a stage one, it's a stage two. It's a Wyckoff model. You can Google it, Wyckoff market stages. Then you have public participation. This is the most powerful stage where you want to go long. And that's the time when you're buying dips, right? When you have a breakout, let's look at UNH, for example, because there are a lot of companies that people are buying. For example, now it's Adobe, Lulu, UNH, CRM. There are a lot of companies that are in a stage four, and people are buying them. The issue is you buy them too early, and then the dip keeps dipping, and you are averaging into this position without any sort of plan, and then you end up with oversized position, and you're basically stuck because you're on the mercy of the stock. You have to wait until the stock turns course. The stage one can take months up to years. You never know. There are some stocks they were in stage one, guys, for 5, 6, 7, 10 years. It's really scary. You don't know. If it's a strong company, sure, but if you're buying something that has a really bad time, or Boeing, how long was Boeing recovering? And still didn't recover really. So you have to be very careful with that. But the stage two is the time when you are buying the dip, and because you feel safe, you're in uptrend, and the dip usually will get bought up and the stock will keep going higher. This was the fall, for example. This is Boeing. Let's look at this chart right here. And you're still in the you see how the moving averages are spaghetti. They are not aligned. The 200 is above the 100, which is really bad, and it's still not really in a nice stage. Now it's somewhere here. April 25th is finally aligning. It could be considered stage two breakout. Let's look at UNH. It's another one that's now really bad. We are in a stage four. Here I have an example for you. So stage two, you get to public distribution where people are taking their profits. It's a battle of sellers and buyers. Are we going to go higher? Are we going to stay? After the stage three, you don't know. The stocks can take break and go higher. But if they decide that there is a dip and then it keeps going lower, and then the moving averages again, as you see the trend line got broken right here, and you see already the 50 is right here to 1020 is getting below the 50. The 100 is also getting above the 50. That's not a good sign. You could already get short or you get out. That's all you need to do. You get out, you wait, and then you need to wait until the stock stabilizes. Now there is the difference, right? The financials of the company, you know the fundamentals, you know the value, and you understand the business model, and you say, okay, this company is really beat up. I'm going to buy for a long term. That's a huge difference than when you're buying in the dip for a trade and you need the capital to trade. You need the capital to pay your bills or buy a house. That's a wrong idea. You cannot do that. If you say, you know what, I have $100,000, I want to invest in some companies, I love UNH, I'm going to buy it when it's really beat up, and you see here, it fall again. It can go back lower, but you might buy it, let's say 2-3 different prices, average in. Ideally, you buy a little bit, add more when it dips even more. So for example, here you could say, okay, this is already the bottom. It's not, because look at the moving averages. This is going to take a long time to recover. That's what I've been telling people. Sure, we went from 240 or 234 up to 300, which is nice. It's $70. We traded right here, the first bounce, right? Quick trade. We got out because usually this takes a long time. You have so many bag holders. The people were buying this dip probably already here, 490. Then they got smoked. Then they were buying another dip. Then we're buying another dip. A lot of people just oversized on this name, and now they're stuck. They're waiting. You have a lot of supplies. These bag holders, the moment the price gets to their level, they will be getting out. You're gonna have to battle a lot of bag holders in order to get the price that you want and make your money back as well sometimes, because if you didn't buy at the low, which is really hard to estimate, right? So that's an example. Let's look at Adobe. It's another one. This has been in a really ugly downtrend, and there is not even really a sign of a bottom, right? We don't even see any horizontal price action. The moving edge is still pointing down, right? Be careful with those, because again, Adobe now might be getting into valuations that are making sense, but hey, did something change with the business model? Are they going to be able to recover? It's going to take a while. Can you sit on this? 100 shares of this stock is $34,000. Do you want to sit on this for a year or two or three? That's what you need to understand, right? As again, you're buying the dip and you get suddenly in the stage 4, you have to understand, first of all, you bought it really high up, most likely. You didn't recognize that the stage 3 turned to stage 4. You need to get out and wait. So you have just so much money and you don't care. You just keep buying. But I don't think there are many people that actually do this. You have to understand fundamentals when you're buying in stage 4 or you're allocating your funds. But ideally, you wait for some sort of price stabilization after this sell-off. Also, you can check ADX. It's the average directional index, which is going to show you momentum. If you have a sell-off and it's still 25 momentum, which is considered above, it's considered high momentum, it's not good. You need to be much lower than that to see that the price is going to stabilize and the momentum to the downside is slowing down, because you don't want to be trapped in this an unfortunate situation. Now we have Lulu. I checked the financials of Lulu. I got a little bit at 196. I posted it in Discord. I'm not happy about these earnings. My other ad will be here around 150. That's exactly the second half of my ad. Add a little bit more and I will have the full position then. Lulu is having a really bad moment. But again, the momentum there was slowing down a little bit. I'm not happy. This is my one stock that I'm not excited about. But again, the valuations at this point are really good. And that way I will be holding, and also I'm sitting on a bunch of cash. That's exactly the same, the huge difference. I wasn't buying up here because it had the first dip. No, I'm going to wait. You can look at a bunch of other stocks and see what stage is there. And CRM also looks terrible. CRM had a double top that was created into this early year, February, and look, this was the target of the double top. Look, it got exactly there, right? This distance was much lower. So that's my demand zone right here. And we had earnings, didn't work well, but look, it got exactly to the breakout where we were playing it. So I might buy CRM. It's beat up. Again, we'll check the valuations. But again, this is a different way than just buying the dip when it's falling this. You want to see some stabilization. You want to see that the stock closed up some sort of double top or head and shoulder pattern, that it's some sort of a bottom. But again, it's different capital you're allocating. Remember, this kind of reversals also take a long time. So you have to understand you won't get your money back that quickly, right? You want to be buying as you're bottom picking. You have to understand it might take a year or two. Another one we bought was Bumble. Bumble is really beat up. But you can see already medium term is long, right? We are changing the direction a little bit. And I'm also buying a couple thousand shares only. We'll add to this position, but I think that this stock is going to have a second breath at some point. Sure, you can play those, but it's different scenario, right? I wasn't buying it here. Imagine I would just start buying the dip when it was $40 or who knows. It would be disaster, right? Look where it's coming from. Bumble is, oh my gosh, the IPO was at 85. This is really bad. Yeah, guys, this is a difference between catching a falling knife and actually investing in a stage 1, I would say, or buying the dip when you're investing at certain valuations when the momentum to the downside is lower. Be careful with that. Always pay attention to the cycle of the stock and the market. Where is the stock momentarily, so you don't get trapped. That's it for today. A little bit of learning, and I hope you enjoyed this video. Smash the like button. You can join us in our trading room. I do a lot of teaching. I love to teach people. I want to share my knowledge and make sure people can do this on their own at some point. And yeah, join us, repost. I will be thankful, and have a good day. Bye.